Welcome back to We Are Cosmic. If you are here, you are not chasing hype. You are trying to understand where real money is going next. And today we are talking about something very important, something that quietly changed the future of crypto. Let me start with this clearly. The era of XRP as a speculative gamble is over. This is not my opinion. This is coming from the top levels of traditional finance. The CEO of a multi-billion-dollar asset management firm has openly stated that XRP is now positioning itself as a core financial tool for the largest market on Earth. Think about that for a second. For years, XRP was trapped in one story: lawsuits, regulation, uncertainty, and endless debates. Many people wrote it off. Many thought it would never escape that shadow. But as we step into 2026, the fog has lifted. What we are seeing now is not a recovery story. It is a structural shift in the global financial system. Most people still look at crypto through the wrong lens. They focus on memes, price pumps, and short-term narratives. Institutions don't think like that. Banks, asset managers, and pension funds are not interested in hype. They are interested in infrastructure. They are asking one simple question: which network can move trillions of dollars safely, cheaply, and instantly? This is where the conversation changes. Right now, the total crypto market is roughly $3 trillion. That sounds big, but compare that to the $16 trillion real-world asset tokenization market expected by 2030. Bonds, real estate, private credit, commodities, all of this is moving on-chain. That gap you see between these two numbers, that is opportunity, a massive blue ocean. And institutions are not experimenting anymore. They want financial plumbing. They want systems that work quietly in the background, like the internet does today. You don't think about TCP/IP when you send a message. In the same way, banks don't want flashy blockchains. They want a ledger that settles value without breaking. This is why attention is shifting toward the XRP ledger. While many blockchains are still testing ideas in labs, the XRP ledger has been processing real transactions for years. Not theory, not white papers, real money, real settlements, real compliance. This is what caught the attention of Stephen McClurg, the CEO of Canary Capital. He is not a YouTuber. He is not a retail trader. He is a seasoned asset manager who understands how institutional products are built. And when someone like that moves from being Bitcoin focused to betting heavily on XRP utility, it sends a signal. This is what I call the utility awakening. Value is no longer coming from hype cycles. Value is coming from transaction volume. XRP settles transactions in 3 to 5 seconds, with fees that cost less than a penny. Compare that to the legacy system, SWIFT, which takes days and charges percentage-based fees. Institutions see this gap very clearly, and they are moving toward efficiency, not ideology. This is not about replacing Bitcoin. This is about something bigger. It is about becoming the rail that moves the world's assets. The gold rush is not coming. It is already happening. And the most important question right now is not, will XRP survive? The real question is, how fast can the world integrate it? When serious money moves, it leaves clues behind. Institutions don't announce their strategies with hype. They move quietly, deliberately, and with long-term intent. To understand why XRP is becoming a focal point for them, we need to look at how institutions think, not how retail traders think. Banks and asset managers do not want innovation for innovation's sake. They want predictability, compliance, and operational certainty. This is where many popular blockchains fail. They are powerful, flexible, and creative, but they are also risky. Complex smart contracts, constant upgrades, and third-party dependencies introduce variables that institutions simply cannot afford. This is where the XRP ledger's design philosophy becomes its biggest advantage. The XRP ledger does not try to be a world computer. It aims to be a world ledger. That difference matters. Smart contract platforms like Ethereum and Solana allow developers to build almost anything. But with that flexibility comes risk. Bugs, exploits, and poorly written contracts have already cost billions of dollars. For a bank, even a 0.1% chance of a catastrophic failure is unacceptable. The XRP ledger avoids this problem by handling core financial functions at the protocol level. Asset issuance, transfers, and compliance features are built directly into the ledger itself. There is no need to trust external code written by unknown developers. This drastically reduces attack surfaces and operational risk. This is one of the main reasons real-world asset projects are choosing XRP. Tokenized gold, government bonds, private credit, and institutional stablecoins require absolute certainty. The XRP ledger provides that by design. Stephen McClurg understands this better than most. His shift from a Bitcoin-first strategy to an XRP utility-focused strategy is not about price speculation. It is about infrastructure dominance. When Canary Capital filed for an XRP ETF, it wasn't chasing hype. It was creating a regulated gateway for pensions, insurance funds, and conservative capital that cannot touch unregulated products. This is extremely important. Most of the world's money cannot buy tokens directly. It needs ETFs, custodians, compliance frameworks, and legal clarity. An XRP ETF acts as a bridge, allowing trillions of dollars to gain exposure to XRP's utility without breaking regulatory rules. This is how institutional adoption actually happens. Another key advantage of the XRP ledger is its built-in compliance stack. Features like asset freezes, clawbacks, and escrow are often criticized by crypto purists. But for institutions, they are mandatory. If a hack happens, funds must be recoverable. If a court order is issued, assets must be controllable. Without these features, banks simply cannot participate. The introduction of multi-purpose tokens, MPTs, pushes this even further. MPTs allow assets to be issued with compliance, identity, and control embedded from day one. This makes the XRP ledger uniquely suitable for regulated financial markets, not just experimental DeFi. Institutions are not anti-decentralization. They are anti-chaos. This is why the narrative has shifted. The question is no longer whether XRP is legitimate. That debate ended with years of regulatory scrutiny. The new conversation is about integration speed. How quickly can banks migrate? How fast can asset managers tokenize their portfolios? While other chains are still running pilot programs, the XRP ledger is already settling live money. That real-world usage creates network effects that speculation alone never can. This is how financial standards are born. In the next part, we will explore a massive shift that most retail investors are missing, XRP's decoupling from Bitcoin, and why utility-driven demand changes how price behaves during market cycles. For more than a decade, the entire crypto market has moved like it was chained to one asset, Bitcoin. When Bitcoin goes up, everything follows. When it crashes, everything bleeds. This has trained retail investors to believe that no crypto asset can escape Bitcoin's gravity. But that belief is starting to break. As we move deeper into 2026, XRP is entering a phase that very few digital assets ever reach, utility-driven independence. This is what analysts are now calling the Great Decoupling. To understand this, you need to understand what actually moves prices. Speculative assets move on sentiment, utility assets move on demand. For years, XRP was treated like a speculative token, even though its technology was built for payments and settlement. That mismatch kept its price trapped in the same emotional cycles as the rest of the market. But as real-world assets begin flowing across the XRP ledger, the source of demand changes completely. When a bank uses XRP as a bridge currency, it is not making a bet on price. It is solving a liquidity problem. The bank needs XRP right now, regardless of market sentiment, because transactions must settle. This creates constant non-speculative demand. That kind of demand behaves very differently. Data already shows this shift happening. XRP's correlation with Bitcoin has dropped dramatically over the last few years. In 2022, XRP moved almost in lockstep with BTC. By early 2026, that correlation has fallen sharply. This tells us something important. XRP is starting to respond to its own network activity, not Bitcoin's price mood. This is a structural change, not a temporary anomaly. When settlement volume becomes the primary driver, downturns look different. In a market crash, speculative assets lose buyers instantly. Utility assets don't. Transactions still need to happen. Assets still need to move. Liquidity still needs to flow. This is why analysts talk about an unbreakable price floor forming under XRP. As tokenized bonds, real estate, and stablecoins increase activity on the ledger, XRP becomes the fuel that keeps everything moving. That demand doesn't disappear just because Twitter sentiment turns negative. It operates quietly, constantly, and globally. The launch of RLUSD, Ripple's USD-backed stablecoin, accelerates this process. Stablecoins act like lubricants in financial systems. They increase transaction velocity and reduce friction. As RLUSD volume grows, it pulls more XRP into active use as the settlement bridge. This creates a mathematical relationship, not a narrative one. More assets, more transactions, more XRP required. This is why XRP is beginning to behave less like a crypto and more like financial infrastructure. Infrastructure does not trade on hype. It trades on throughput, reliability, and cost efficiency. At the same time, the XRP ledger's transaction fees are burned permanently. In speculative markets, this burn is irrelevant. But in a high-volume settlement environment, even tiny burns add up over time. Increased usage slowly reduces supply while demand continues to rise. This is how pressure builds quietly. Most retail investors miss this phase because it is boring. There are no flashy pumps, no meme-driven candles. But this is exactly how institutional assets are built, slowly, methodically, and underneath the surface. This is also why XRP could behave very differently in the next major market downturn. While speculative assets may collapse under fear, XRP's utility demand may keep it structurally supported. That doesn't mean price only goes up, it means price becomes more resilient. A strong bullish case means nothing if you ignore the risks. In fact, the fastest way to lose money in crypto is to believe that one asset is guaranteed. So before anyone talks about price targets or future dominance, we need to clearly understand where the XRP thesis could fail. Let's start with the biggest risk, competition. Right now, programmable blockchains like Ethereum and Solana dominate developer activity and existing DeFi liquidity. Ethereum alone controls the majority of current real-world asset tokenization projects. This matters because network effects are powerful. Developers build where the users are, and users go where the liquidity already exists. Even if the XRP ledger is technically superior for settlement, that does not automatically guarantee adoption. Technology does not always win. Ecosystems do. Ethereum offers flexibility. Developers can build complex financial products quickly. That chaotic innovation attracts experimentation, and experimentation sometimes leads to breakthroughs. XRP, by contrast, prioritizes stability and control. That makes it attractive to institutions, but less exciting to builders who want freedom. This creates a real risk. If the market decides that permissionless innovation is more important than regulated efficiency, XRP could find itself sidelined. In that scenario, banks may still experiment with XRP, but the center of gravity could remain elsewhere. The second major risk is centralization perception. Features like asset freezes, clawbacks, and protocol-level controls are essential for banks. But to crypto purists, these same features represent everything they dislike. If public sentiment shifts strongly toward censorship-resistant systems and away from institution-friendly models, XRP could struggle to win mindshare. Crypto is not just technology, it is ideology. And ideology can influence capital flows more than fundamentals, especially in early markets. The third risk is adoption speed. Even if XRP is the right solution, legacy institutions move painfully slow. Banks operate under layers of regulation, internal approvals, and legal reviews. Tokenizing trillions of dollars is not something that happens in months. It happens over years, sometimes decades. This creates a timing problem. Crypto markets move fast. Investors expect rapid results. But institutional finance moves at a glacial pace. If adoption takes longer than expected, price appreciation could remain muted for extended periods, testing investor patience. Another risk comes from execution. ETF filings, stablecoin launches, and partnerships all sound great on paper, but execution matters more than announcements. Delays, regulatory pushback, or technical issues could slow momentum. Even small setbacks can have outsized effects in crypto markets. We also need to acknowledge regulatory risk, even if it is lower than before. Laws can change, political priorities can shift. A friendly regulatory environment today does not guarantee the same conditions tomorrow. This is why diversification and risk management matter. Finally, there is the risk of overestimating institutional demand. Institutions may explore XRP, test it, and still decide to limit exposure. Not every pilot turns into full-scale adoption. The gap between interest and commitment can be wide. Understanding these risks does not weaken the bullish case. It strengthens it, because now we can see where the real variables are. The legal risk has largely faded. The technical risk is relatively low. But adoption speed and competitive pressure remain the biggest unknowns. Smart investors don't ignore these threats. They plan around them. They size positions correctly. They avoid emotional decisions. And most importantly, they stay flexible. Now the center of gravity is shifting. The next wave of demand is not emotional. It is structural. Stephen McClurg has openly stated that the interest canary capital is seeing today is not coming from speculators. It is coming from pension funds, insurance companies, and conservative asset managers. This is the most careful money on the planet. These institutions do not chase 10% pumps. They move when they see long-term necessity. This marks a critical transition. Retail investors buy XRP hoping the price goes up. Institutions buy XRP because they need it to move value. That difference completely changes supply dynamics. When a pension fund or insurance company tokenizes real estate, bonds, or private credit on the XRP ledger, they create permanent transactional demand. These assets don't trade once and disappear. They settle continuously. That means XRP must be sourced, used, and recycled constantly. This is not optional demand. It is operational demand. Another important factor is how institutions manage risk. Large banks do not rely on a single exchange or gateway. They build redundancy strategies, multiple KYC compliant accounts, multiple liquidity providers, multiple settlement paths. This behavior quietly removes XRP from public exchange liquidity. As institutions build vaults and settlement infrastructure, they hold XRP not for speculation, but for availability. They cannot afford to be locked out during volatility. Over time, this reduces circulating supply available to retail traders. This is how supply dries up without headlines. Data already shows institutional inflows into XRP-related products rising sharply, outpacing retail buy-side volume for the first time. This is a passing of the torch moment. Retail enthusiasm brought XRP this far. Institutional capital is what scales it, and institutions think in decades, not weeks. This is why price discussions often miss the bigger picture. People ask whether $5 or $10 is realistic without asking what XRP is being used for. When trillions of dollars in real-world assets are settling across a ledger, the price of the bridge asset becomes a function of throughput, not hype. This is where analysts start modeling XRP like infrastructure, not like a startup token. Another subtle but powerful factor is token burn. Every transaction on the XRP ledger burns a small amount of XRP. For years, this was irrelevant. But in a high-volume institutional environment, burn rates increase naturally. No dramatic supply shock, just steady pressure. This creates a tightening system, more usage, more demand, less available supply. Most retail traders never experience this phase because it is quiet. It doesn't trend on social media, but it is exactly how commodity markets and settlement assets behave in traditional finance. We are also seeing the rise of ETF exposure, which further locks supply. ETFs remove tokens from circulation and place them into long-term custodial structures. This reduces volatility but increases scarcity over time. This is why institutions are not asking whether XRP will moon. They are asking how much they need to secure liquidity. At this stage, the conversation around XRP is no longer emotional. It is analytical. The market is transitioning from guessing prices to calculating flows. This is a very important distinction because price targets in a utility-driven system come from math, not hype. For years, XRP's price was controlled by sentiment. Tweets, rumors, court dates, and Bitcoin cycles pushed it up and down. But that model breaks when an asset becomes financial infrastructure. Infrastructure is valued based on how much value it moves, how efficiently it does so, and how essential it becomes to the system. This is why the $5 XRP roadmap is now being taken seriously by institutional analysts. When you model XRP as a bridge asset for real-world assets, you don't ask how many traders will buy it. You ask how much liquidity is required to settle tokenized bonds, real estate, stablecoins, and private credit. Even a small percentage of the global bond market moving onto the XRP ledger requires billions of dollars in active XRP liquidity. At that scale, $5 is not aggressive, it is conservative. Standard Chartered and other institutional players have already started publishing models that assume ETF inflows and real-world asset settlement growth. These are not retail YouTubers. These are banks that build valuation frameworks for sovereign debt and global commodities. Another key variable is velocity. XRP doesn't need to be locked forever to create value. It moves quickly, but higher transaction volume still requires larger base liquidity pools. As volume increases, the system naturally demands higher price stability, which which pushes valuation upward. This is also where RLUSD plays a crucial role. Stablecoins increase transaction density. More stablecoins mean more settlement activity. More settlement activity means more demand for XRP as the bridge between assets. Again, this is math, not belief. We also cannot ignore burn mechanics. Each transaction burns XRP permanently. At low usage, it doesn't matter. At institutional scale, it slowly tightens supply. This does not create explosive pumps. It creates long-term pressure. Now let's talk strategy. In a utility-driven market, timing becomes less important than positioning. This is not a meme coin cycle where you chase 10x moves. This is closer to how early internet infrastructure investments worked. Slow adoption, long buildup, then massive embedded value. That means risk management still matters. No asset is guaranteed. Adoption could be slower, competitors could gain ground, regulation could change. This is why a redundancy mindset is essential. Multiple exchanges, multiple custody options, and a clear exit plan. The biggest mistake retail investors make is focusing only on upside and ignoring operational risk. Institutions never do that. They plan for failure scenarios first. The most important shift, however, is psychological. By 2026, the line between crypto and finance is fading. XRP is not trying to replace banks. It is becoming the rail they use. Just like TCP/IP quietly powers the internet, XRP is positioning itself to quietly power value transfer. When that realization becomes obvious on the charts, it will already be too late to front run it. The real question is not whether XRP hits $5. The real question is whether you understand why it could. Because if you understand the reason, you don't panic in volatility, you don't chase candles, you operate with patience and clarity. The era of speculation is closing, the era of utility has begun, and now the final question is yours. Are you prepared for the decoupling, or are you still watching price instead of rails? If you found value in this breakdown, explore the next video on your screen to stay ahead of what's happening inside the XRP ecosystem.